Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Jon Kalikow, more than 2 decades of experience in the derivatives and converts market, provided important lessons on risk management and the reality that even well-designed trades rarely go strictly according to plan. Our conversation explores lessons imparted by Mr. Market, both during the Dotcom bubble and the global financial crisis. In the former, efforts to strip out the optionality embedded in convert positions were stymied by basis risk across markets. And in the period leading into the GFC, Jon grappled with the burden of option carrying costs, even as his firm was well positioned with long convexity on subprime and U.S. financials. Today, Jon is president of Gamma Real Estate and AFC Gamma, a public REIT in the cannabis space. Through our discussion, we learn more about the risks and opportunities in real estate lending through Jon's lens as a creditor. Noting that lending has a similar economic profile to equity put selling, he contrasts the two by drawing attention to the complex decision tree required to take delivery in a real estate transaction, something Gamma ultimately did in 2017 after a borrower defaulted. Next, our conversation explores credit extension in the cannabis industry. We learn more about the unique regulatory issues in the space and how Jon and his team evaluate borrowers in seeking to construct a diversified portfolio of loans. We also learn more about the differences in state regulations and how that impacts AFC Gamma's appetite for lending. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Jon Kalikow. My guest today on the Alpha Exchange is Jon Kalikow. He is the president of Gamma Real Estate, also a co-founder of AFC Gamma, a REIT doing some lending in the cannabis industry. Jon, it's great to have you as a guest on the Alpha Exchange.
Thank you very much, Dean. It's great to be here.
Well, we go back quite a ways, and you've had a really interesting career across both public markets and derivs and converts, but also focusing on lending against actual collateral and now doing a lot in the cannabis space. So what we're going to do is stitch all these things together and really hear just in terms of your career development. So get us started at the beginning. You got into markets in the 90s. Tell us a little bit about the early days, about how you got into the converts market, and then we can weave into some of the episodes of crisis that you've traded through as well. But tell us about your start in the industry.
My start was as a proprietary trader in the convertible arbitrage space back in the mid-90s. At that time, we were looking at converts as more as a fixed income product and stripping out the equity aspect through selling long-dated options. Those were flex options. You basically listed OTC options at the time to synthetically create a fixed income bond at a wider spread than otherwise could be gotten in the market. So very interesting learning experience, both in terms of getting exposure to the equity options market and to fixed income trading and how those things behave in all sorts of changing market dynamics. So that was the base. From there, I was partnered in a hedge fund that I had sold. And then my last direct stint on Wall Street was as head of trading at a hedge fund based in New York called Solus. We did much better than most in the '08 crisis, having a decently short bent both on RMBS, CMBS, and put positions on a bunch of the financials. After the crisis, I reassessed where I was. I was at that point in my early 40s, and I decided that I wanted to transition to something where I could build a product, build a company that didn't reset annually the way kind of the hedge fund industry is known to do. And I started a company originally called Triton, focused on real estate and real estate lending in Texas and North Dakota oil fracking areas. From there, I grew the company, renamed it Gamma, and started lending across all real estate throughout the U.S. We also began buying certain real estate products, especially multifamily in the South. And that kind of takes us up to COVID. And I'll go into specifics with you in a little bit. But what I've always tried to do, both in Wall Street and after Wall Street, was pick areas and pick trades, so to speak, that were not the popular ones, where I thought there was a pretty vacant area where you can exploit some asymmetry. When fracking, for example, was getting going in 2010-11, that technology wasn't very well known, and oil prices, at the time had been not too volatile. EV was a distant dream at that point, but nobody actually thought early on that the fracking would take off necessarily the way it did. But we went in there almost as picks and shovels and provided housing for the oil workers. And there weren't a lot of us doing that at the time. And that wound up being a very interesting area to try to gain some alpha.
So let's go back and really just get some of your commentary about the early days in your career, because I think it's so interesting. You go back almost 30 years in the convert space, and it's evolved a lot. I mean, even in the period of time when you were very active in converts, it had evolved a lot. I'd just be curious if you can go back, and I know you do have quite a memory. So thinking about the period, let's say from the mid 90s into the tech bubble, and how the convert market evolved during that time period. You had this bull market, but also a bull market in volatility. And you had a real ramp up in terms of growth of the convertible product. Those were really good years for issuance. What are some of whether there are specific situations or specific pieces of paper that you took down and traded through that you can bring to life for us from that time period?
Well, one of the most interesting times was when long-term blew up. And what I remember most about that time is realizing that all that they taught us at Wharton in practice wound up not being true. The theory was very much detached from the actual experience. What I mean by that is when you're long a convertible bond, if you want to hedge your interest rate risk, you would be short some type of treasury instrument against it. What they don't tell you, though, is when markets become extremely volatile, especially the downside, you have a flight to quality, and those hedges go against you as treasuries rally in flights of safety. The same way that they teach you that if you're long 100 shares of IBM, that's a more risky trade than being long 100 shares of IBM and being short a covered call against it. Unfortunately, what happened back then to us in the convert space was the short calls that we had positioned against our long converts wound up seeing volatility spike so much that even though the underlying stocks dropped, the short calls went up in price. And that was another remarkable thing to see in practice, because it was really the antithesis of what I had expected. Additionally, you kind of saw the lack of a fixed income bond floor in the converts. You had much more momentum buying and selling, and the fact that companies, may not survive, but there was really no sense that, okay, we're going to trade this like a fixed income instrument. It really did capture the volatility embedded almost in the underlying stock. So that was a very, very big eye opener, kind of forcing me to question a lot of what pundits and the majority were saying. At that point in time, you had a couple very interesting bonds. Apple had a 6% convert. This was when Apple's stock was in single digits and people didn't know if it was going to survive or not. Amazon had a bond. AOL back in the day had a bond. But one of the most interesting stories I could give you was with a convertible called Coleman. Coleman had a zero coupon bond and was under the Ron Perlman holding company, Andrews and Forbes, and was consolidated up into it. And this bond was issued by Merrill Lynch and Morgan Stanley. And what we realized when we read through the documents attached to the bond was that if you owned enough of the convert and you put that convert in for conversion into the common stock, the company had to pay you out in cash and not stock. Otherwise, it would have deconsolidated Coleman from the parent company, which they couldn't do. And the way this convertible worked was you would be priced off of the prior day's closing price. Okay. So we had a bunch of these bonds, and at the time we were at Morgan Stanley, my mentor and I. And it was late on a Friday during the summer, and the stock loan department at Merrill Lynch called us. It was not our usual stock loan rep, but called us and said that we were having a buy-in on our short stock on Coleman. So we used this as the opportunity to very, very aggressively cover this stock. And we saw the stock rally probably 200 to 300% in the last hour of trading. And it was so late in the day that they didn't halt the stock. Nobody understood what was happening. But when the stock closed, we put our bonds in for conversion, knowing that we had to get paid off on that last print. What my mentor later found out, as did I on Monday morning, was even though we had made nearly $50 million on that trade, Ron Perlman called Joe Perella, who was head of banking at Morgan Stanley at the time, and basically flipped out. And the banking clients at Morgan Stanley were much more important than us as prop traders. So we wound up having to unwind the trade and split a big loss with Merrill Lynch to soothe and assuage Ron Perlman's annoyance. And so again, I learned a very important lesson, which is personal relationships certainly can trump in this business, being smart just on the math. There are multifaceted aspects to what's going on. And that was a very important lesson that I luckily learned early in the game.
Well, you had this incredible period of volatility, and you could put LTCM in there. You can, of course, include the tragic events of 9/11. A year past that, the U.S. was in recession, and stocks like Tyco and WorldCom were blowing up. So there was still plenty of volatility well into 2002 as the telco bust was occurring. Then you had this incredibly low vol period for 3 to 4 years in the buildup of the financial crisis. So take us through maybe the period into 06 and 07 as you guys started to understand that the things were, potentially set to go awry, even as the VIX was coming down below 10 in early 2007, and how you used optionality in trading through that.
Sure. So right about the time, early 2000s, the CDS product came on the scene. And it was obviously well received. And we, because that's just how we tended to operate, wanted to learn and understand this product, ahead of the majority of others, because we did feel like it was going to become something important to Wall Street and to portfolio management, to trading. And one of the ways that frankly worked out in our favor was with the General Motors bankruptcy and reorg around 2005 that started. And what that kind of alerted us or focused us onto was the fact that companies that have for decades and decades, nearly a century, been thought of as, the pillar of American industry could never go anywhere. The rug could be pulled out from unknown sources. Enron, WorldCom, Tyco, those were things where I'm not going to say one should have known, because I never would have. But those were certainly big established companies that wound up, falling precipitously. So after the autos that we made a good deal of money on, we started looking for other holes and other potential pockets that were underappreciated and underexploited. And one of the first things we started digging into were the monolines. And we quickly realized that there was a good deal of exposure there to companies like AIG. And we wound up getting decently sized in the short RMBS. From there, we started looking at exposure into some of the banks, Merrill, Lehman, Bear, a bunch of insurance companies and such. And we wound up establishing long put positions on a bunch of those names. Now, we'd been decently early. We were bleeding a ton of data holding these long positions, certainly at the end of '05 into '06, but we were more and more convinced the correctness of our thesis. So we kept building in that direction. And those option positions obviously wound up working out very well at the end of the day. But there was a ton of time when I felt like my daily carry on those options was so enormous that it definitely caused some sleepless nights. Mark to market can kill you much easier than most people understand. So I was always aware of that, but the conviction in this trade was just something that was too great to overlook.
There's so many lessons in that period before the crisis. I just remember, for example, XLF vol was maybe 13 and S&P vol was maybe 11 and a half. There was just this incremental spread of financials vol over S&P vol. And of course, that spread gapped out to maybe 50 to 70 at some point, just given how toxic and central the financials, U.S. financials were to the entire crisis. Here's where I would love to take the conversation, because to me, when I step back and I look at some of the similarities between whether it's lending against collateral, commercial collateral or residential collateral in terms of buildings, or in doing some of the lending your firm is doing now in the cannabis space, there's a couple of corollaries to traditional finance, traditional markets-based finance, one of which is the regulatory environment. The regulatory environment really dictates the terms around which folks can do business, the way in which they interact. And it's easy to argue that in some ways, a lax regulatory environment enabled the buildup of all the leverage in U.S. housing, and then perhaps was central to the unwind and all the vol. So I know that there's a lot of shifting landscape in terms of the regulatory environment for cannabis. So I want to get to that. And then also just this idea of quiet markets leading to people's exposures or their books getting very big, and that maybe being part of an ultimate unwind. And so I think that there's a corollary in terms of traditional markets and markets like New York City real estate, or just in general real estate lending. So that's where I'd love to just try to get you to help us see the kind of big pictures of where what you're doing now overlaps with some of the discipline and risk management from traditional markets. So let's start with Gamma Real Estate. Tell us a little bit about the venture, the ways in which you guys have gotten involved on the lending side, and then let's just try to weave in the lessons that you've taken to building that business that you learned from traditional markets.
Absolutely. So we took a fundamental bottoms-up approach to real estate lending where it was basically asset-based lending. We would certainly vet the borrower, but we, at the end of the day, wanted to know that the loan to value based on the collateral was low enough such that the rate we were getting compensated for the risk. And the backstop in my mind for these loans was in the event of a default and in the event that we would have to possess the collateral, we as a real estate company would know what to do with it. And my analogy in the very beginning was that of selling puts. If you sell a put and you're assigned, now you're long stock and you can decide what you want to do with the stock. You sell, hold, trade, what have you. That's not exactly a one-to-one analogy, it turns out. And that's because these are not markets that are nearly as, these are much more regulated markets and much more accustomed to external forces that can throw a wrench in things. Let me give you an example of what I mean. We had made a loan on the Upper East Side of Manhattan on 58th Street in Sutton to a fellow who had been a developer in Connecticut, had some problems in the crisis, but never, to file bankruptcy and worked things out with his lenders at the time. And we liked the thesis behind what he was trying to do. He was exploiting a loophole in New York City zoning that enabled him to build a very big tower in the middle of the block on 58th Street, right off Sutton. So we lent him money, and with several months left in the loan until its maturity, there were a couple buyers of the property that approached him, and he could have sold the property, paid us off, and made order of magnitude $50 million profit. Instead of doing that, which we begged him to do, and we thought was the absolute rational move, he continued to seek funds to enable him to build the building himself so he could make $500 million. Unfortunately, as we basically predicted and told him, he was unable to source that money and he wound up defaulting. We offered him all his money back in exchange for him deeding us the title. The reason we wanted title so badly was this borrower had gone to the New York Times and the Wall Street Journal and bragged about this upcoming 1,100-foot building he was going to build. That enraged the community, and they set off to try and change the zoning to prevent it. So now that we, as the lender, were looking at our collateral, seeing a tremendous loss in value if that zoning change were to happen, we had to jump in and protect our collateral. So this borrower wound up finding a backer very quickly that thought that they could hold us hostage almost like a green mail by tying us up in bankruptcy. So what happened was, instead of him accepting his nearly $7 or $8 million back that he had invested and us receiving title, he wound up filing bankruptcy. That bankruptcy lasted 9 months. There was a full trial in bankruptcy. I was accused of every type of bad practice in lending. We won every single one of them. But 9 months was burned, in which the community was moving towards the rezoning. So I didn't have the luxury of the decision-making process one would have if you're assigned a short put and long the stock. I had to move forward with building this building in order to get grandfathered, so the zoning change that I was pretty sure was going to happen wouldn't affect us. So it was kind of a race against New York City.
Well, this is interesting. I mean, I think we can draw in this analogy of, if you're a lender, you're some version of a put seller. That's what credit is. And then this idea of being short a put and taking delivery of a stock, which might be challenging from an economic standpoint if you've lost money on the put, but the operational aspects seem pretty clean. You're just going to take in the stock and either dispose of it or decide to go long the stock. And the corollary to real estate lending, and just how you've described the decision-making tree that just takes on a life of its own, is rife with legal implications and all kinds of negotiation around things like putting someone into bankruptcy. I think it's pretty fascinating. I wanted to also ask you to help us understand the price of risk as it relates to some of the business that you've done on the lending side, specifically against real estate collateral. We can kind of think about the VIX as some version of a cost of insurance. It's a price. It references the insurance cost of stocks in the S&P 500. We know it can go very low. It can go very high. There's kind of a VIX for every market. There's some clearing price that goes up or down depending on maybe the riskiness of the market from a macro standpoint. Maybe the availability of capital sets the conditions under which risk is exchanged. New York City real estate specifically has gone through periods where capital is not that available, and so the lending gets done at higher rates. And then there's these boom times where, and I just remember very specifically you telling me as late as 2019 that there was so much lending going on that it was the lenders themselves you had to watch out for because they themselves were taking on leverage. So take us inside the kind of almost the time series of where business has printed, just your sense of, wow, it really feels like there's so much competition to lend that it's getting overdone and collateral standards are getting eroded, credit standards are being eroded. Give us some insights there just in terms of, let's say, the post-crisis period, post-GFC period in terms of lending.
So coming out of the crisis, you had new regulations such as Dodd-Frank that really hindered the regional bank's ability to do things like construction loans, for example. And some of those legislation that was promulgated really did make private lending, especially in real estate, a much more attractive activity because your competition from banks was going to drop massively. And there was still, 2010, 11, 12, not a tremendous amount of private capital directed towards lending at the time. And therefore, certainly to us, it looked like a really interesting playing field and opportunity to make money. And if real estate lending had the known variables that exist in options trading, it would be awesome. And what I mean by that is when you sell a put, you know how much premium you're taking in. When you buy an option, you know how much it's going to cost. And you can run scenario analysis and you can bound your risk based on the math itself. In lending, especially in a place like New York, the laws and rules are so tilted in the favor of the borrower in a lot of ways that a very, very successful trade can be made into a very, very troubled trade. So let me explain. We've had loans in states like Texas, where in the event of a default, you can foreclose on your borrower with basically 30 days notice. It's extrajudicial, and it's very clean and straightforward. In New York, if there's a default and you have to foreclose on this property, you could wind up in court for years. We had a foreclosure in Brooklyn. We were in court for over 3 years before we could get title. Now, in 3 years, markets can change massively. You have carry costs. You, as the first lien lender, may have to deal with liens that came in after yours, just because if you don't, it'll complicate the court decision even more so. I'm a lawyer. I went to law school at night while I was working on Wall Street very early in my career. And I can tell you what they don't teach you in law school is that judges have almost complete discretion on how they want to interpret the law.
Help us bridge the gap between some of the excesses that become obvious maybe at the height of a cycle where lender protections are really eroded. We all know about PIK toggles and different structures and that sort of thing. What's the equivalent on the real estate side, and what might the implications be, if there are any, for just the availability of credit? In other words, is there a scenario here where the economy slows and people who have made these loans so far, potentially at prices or protections that they regret, is there the potential that the allocation of credit is compromised, or is there just too much capital still waiting to find a home?
Well, right now and through COVID, there certainly seems to be more than enough capital on the sidelines. I was frankly surprised and remain surprised that we haven't seen more defaults by lenders or more problems widespread, because hospitality loans, hotels, loans on hotels, office, loans on office did so poorly during that time. But you really didn't see that reflected in the metrics or even anecdotally that much, which to this day surprises me tremendously. And I can only chalk that up to enough capital, enough structure that enables capital to remain locked up so you can kick the can as far down the road as you need to. Remember that for the most part, real estate tends to go up over time. There was a report, I think it was by Goldman Sachs several years ago, that basically if you hold a basket of diversified real estate over the last 100 years, as long as you have at least 6 or 7 years of holding period, you would never have lost any principal. So real estate certainly tends to go up over time. So if you can kick the can long enough, you should be okay. Now, again, that works unless a mark-to-market event or a leverage event, takes you out of the game. And leverage was certainly increasing pre-COVID when there was a desire for yield and avenues to source yield were few and far between. But I guess the lesson out of 2008 that translated was patience is rewarded, even if it means in the short term you're going to have to suffer and take a little bit more risk than you would have been comfortable with. The peers of ours that do commercial real estate lending tend to be pretty disciplined and rigorous in their underwriting. And I haven't really seen that change too much as of late. Now, what you're likely going to start to see, though, are larger and larger pools that need to do things instead of on a bottoms-up analysis of the fundamentals on a kind of top-down bell curve, meaning we're going to put out this amount of loans or this amount of dollars with the expectation that these will default and these will repay. What can happen, as you just alluded to, Dean, is that if you get into a very, very difficult period of time and defaults run rampant, you won't have the wherewithal to service those defaults. And now you're going to really be in trouble because the value of your collateral will drop as things progressively worsen. We saw that with pockets of the hotel lending during the pandemic. Borrowers would default. Lenders who were hotel lenders now had many, many hotels that basically they had to operate themselves, whether through a receiver or, back channel, but certainly had to have a say in running these hotels and making decisions. And if you have a rash of defaults, you're not going to have the wherewithal to do it all at once. So I think in private credit right now, there are certainly areas where things can get real bad. But for the most part, I think high LTV lending on non-cash flowing properties has dropped massively. And that's, I think, a good discipline that's come out of the COVID pandemic.
So, Jon, now let's switch to your latest venture, AFC Gamma. So you're engaged in being a lender in the cannabis space. And we said a little bit earlier just about the regulatory climate and just the impact on borrowing and lending in public markets, certainly in markets like New York City real estate. That's got an impact in terms of the risk profile of what you're doing. And in cannabis, which we'll be eager to learn, the regulatory climate is shifting, evolving. It's extremely uncertain. But take us from the beginning in terms of the genesis of this business and how you and your partners are approaching it.
Structurally, knowing that some of the real big lenders, players, banks, what have you, would have trouble because it was federally illegal, I thought that there was an opportunity for asymmetric risk and reward in our favor as long as the landscape remained as it is today. And early on, both myself and my partners did not feel that you would see mass federal legalization anytime soon, and we still firmly believe that. We see the states remaining very much in control and the federal government taking a very long time to really change that. The fact that marijuana is still federally illegal and is deemed an illegal substance means that those who are operating in it have a very difficult time banking traditionally. So you have a lot of cash. Visa and MasterCard can't operate. And the capital markets are extremely inefficient and underserved because, like I said, so many of the large lenders can't lend. When COVID began, we felt very confident that the cannabis industry was going to remain very much unbanked for quite some time. And that's because we did not see the federal illegality going away. Each state has its own rules and regulations, so every jurisdiction is very different, and the tax that the states are collecting is not something they're going to want to give up and see grow happening in California and the product being sold across state lines. You've seen a bunch of pink sheet listed companies, several Canadian, several American, and there are a few different kinds of companies in cannabis. You have those that cultivate and grow the product. You have those that produce, manufacture things like tinctures and gummies and things like that. And then you have dispensaries that sell through the retail channels. You also have verticals, which is mandated in a state like Florida. You have to have the whole chain under one ownership group. And then you have something called an MSO, which is a multi-state operator, which are folks who operate in several different states and jurisdictions. it was very interesting to us because of the differences between states and because of the inability for many of the larger banks, private equity folks to participate in the space. And because of that, our ability to earn outside returns through lending was very much increased. So what we found fascinating is really the willingness of these entrepreneurs to take debt at high teens, low 20s rates because it was still a much cheaper alternative than them going out and raising equity, given the growth trajectories they all saw and believed were embedded in their companies. So it was an opportunity for us to lend in what I would deem a pretty safe fashion from an LTV perspective because we were being collateralized by real estate, by the licenses, and by the operations of the company itself. And we're certainly believed that we were getting paid for risk here. Very different than New York, where many of the loans we would have normally made several years ago at 10, 11% is now pricing at 6, 7%. And we didn't think we were being compensated for that risk. So pivoting to cannabis lending made a ton of sense.
So just stepping back and just thinking about the borrowing and lending within this industry, help us understand. So of course, on the lending side, the capital providing side, there are people like you. So I'm just interested to understand a little bit more of where the capital comes from, because it's very specific. There's, again, as you point to, a lot of regulatory uncertainties to be navigated. It's kind of a high risk, higher reward industry from that perspective. And then help us understand the borrowers. So you've mentioned growers and you've referenced some of the verticals. I assume there's equipment and so forth. So on the capital needs side of things, what does that look like? And maybe tell us what the trends are over the past couple of years in terms of where folks are trying to raise capital.
So some of the first movers were folks who really just had an entrepreneurial spirit, were going to learn on their own dime, and saw a vacuum and an enormous need and demand from the public. So we have borrowers who were previously lawyers, some folks who were in finance. We are now seeing some with agricultural experience come in and supply chain management come in as these companies get more and more sophisticated. But generally, it was folks who really saw an enormous trajectory to the up and right on both margins, on scalability, and on sales. What I think was very much underappreciated by many of the entrepreneurs is that the cannabis industry is just like any other industry at the end of the day, where supply-demand dynamics absolutely come in and affect pricing, and there is a degree of elasticity. So you really do have to be able to operate a company well in order to succeed long term. We are not the only lender in the space. There are a few others, a handful. There are family offices who will do one-off lending as well. These are family offices, and a lot of times owned by folks who are in a financial job that does not allow them to lend to cannabis. But the largest player in what I would call the capital providing space for cannabis is a New York Stock Exchange listed stock called IIPR. IIPR trades at a multiple of book value because they do something called sale leasebacking, where a cannabis operator will sell IIPR their building and then take back a 15 to 20 year lease. And IIPR gets a lot of credit for the duration embedded in that lease. The issue for the cannabis company is early on, they might not mind binding themselves to a lease that increases, let's say 3%, escalating each year for 15 years when they see margins expanding and growth, tremendously strong. Right now, we're seeing a contraction in the market and weakness in the stocks because prices have come down, order of magnitude in some markets from $4,000 a pound a year ago to $600 a pound. You've had competition come in, so the need to operate better has helped. The belief that you're going to have significant legislation to make it easier to operate is further off in the distance. And one of the biggest problems that's largely not talked about or underappreciated is something called 280E. 280E is an IRS tax code that says you can't offset revenues with costs of goods sold if you're trafficking in illegal substance, which cannabis still is considered. So you can have EBITDA positive companies that have negative free cash flow, a big problem for a lot of these companies. All that adds up to the fact that it's still a difficult industry in which to become successful. There is huge amounts of growth and potential here, but the regulations are certainly one of the biggest hurdles that are in place. And speaking of regulation, one of the reasons the cannabis industry remains under pressure is what I'll call indirect from regulations. Let me explain. There's a big black market in cannabis still, both California and New York. And in both of those states, because marijuana has been so decriminalized, there's no enforcement really of trafficking and selling marijuana illegally. So those with the licenses really are at a disadvantage because they're actually paying the taxes, they're paying payroll, they're doing things, very much above board, and the black marketeers are not. And there's no real enforcement against these illegal folks. So you have a very much asymmetric field, and the only way that could really be addressed is if you start enforcing some of the rules and laws to make it worth spending all the tax and costs to develop a business in cannabis.
Let me bring it back to evaluating credit risk, because as a lender, you have, in the best case scenario, the debt is serviced and you earn a good return in terms of the cash flows. But of course, there's the downside of things not going as planned. And I'm just thinking about you as a credit investor, as a convertible investor, the embedding of puts and calls in the structure. It could be subordination rights. It could be in converts, something like dividend protection. All these little pieces of the contract turn out to have real economic value. And so I'm hoping you can translate some of the particulars in cannabis that you've come across as a lender, the types of things that, one, maybe keep you up at night, where, something that isn't accounted for in your evaluation of the credit and the risk, and the types of things that are in there that serve as a protection for you as the lender.
Sure. So first and foremost, when we decide to lend, we stay away from jurisdictions that don't have limits to the licenses. We're concentrating only on those states, mostly eastern states, where licenses are very limited. So we've not lent in California and Oregon and Washington or in Colorado, and pricing in those markets has really decreased. When we lend, we're looking at three pillars. So first, you have the real estate. We lend through a REIT, so we do need real estate coverage. And we look at the alternative use of the real estate as well as the real estate's money-generating ability as a cannabis dispensary or cultivation facility. But we also collateralize the license, which is important because without the license, you would be unable to utilize the real estate for cannabis. And lastly, we're lending to the company itself, so we have the cash flows and guarantees at the corporate level as well. So you have those three inputs all giving you some protection. Now, one of the reasons I really like lending in cannabis space is if a borrower does run into a problem, there are several levers that they can pull before they have to default and turn over the keys, so to speak. They can sale lease back their property. They can raise additional equity. They can do asset sales. And if all that fails, which we never want to see one of our borrowers, fail, obviously, we hope that the loan we've made is sufficiently asset covered. And I think that our underwriting is tight enough and is conservative enough that that's certainly where things stand. In terms of going out on the credit curve, we tend to shy away from folks without experience, without cash flow, who have pure startup construction. And those are, to us, mitigants to the risk. And we feel as though we don't really have to go out on the risk curve because there's so few folks lending. We can get the rates of return that we desire without taking much of any leverage and without really going out on the risk curve.
So here's what I'd like to learn a little bit more about is when we think about this sector, this space, it's got its own unique properties to it. Again, it's a very different than, traditional markets where borrowing and lending occurs. You've referenced this regulatory uncertainty. So I'd like to understand that a little bit better in the following context. The degree to which when you are trying to put together some diversified portfolio of loans. You obviously want to pick the highest quality, but you also want to try to find diversification. And you seem to have mentioned some of that diversification might come from area. So different areas have different risk profiles. And so that's really what I'd like to understand a little bit more is how diversified can you be in an environment where there is this regulatory uncertainty that would seem to potentially have impact on the entire space. Take us through how you think about the kind of portfolio construction process in terms of loans.
Well, the biggest risk that we see to cannabis lending is really the states themselves changing the rules as they relate to licensing. For example, about a year ago, Florida licenses were trading at around $50 million. I believe that price is now down to about $15 million. Because Florida had issued 23 more licenses than they originally had. So those additional licenses was unexpected and certainly caused downward pressure. It's very costly to enter the state of Florida, given the cost to build and everything. And that also is going to lead to diminution of value. So a lot of the issues with risk have to do with the regulatory landscape. When Biden was elected president, there was a lot of optimism that you would see some federal legislation. When it was clear that that wasn't going to happen so rapidly, that was yet another blow to the industry, causing a leg down in the stocks, given the operators knowing that they won't be able to access cheaper capital anytime soon, nor would they be able to necessarily have their customers use credit cards or other easier means of purchase than cash. With the continued growth in the industry, though, we hope the capriciousness with which certain states operate and try to maximize the tax today as opposed to incubating the industry's growth for the long term, we hope that starts to make a lot more economic sense for everybody. And we hope that some of the states that are doing better teach some of the states that are doing worse how they should be operating. For example, the state of Missouri is likely going to go from just medicinal legal marijuana to allowing recreational marijuana shortly. And what the state has said is they're going to lower their tax rate significantly below their neighboring state of Illinois. And that we think is very smart. It'll drive business to Missouri instead of seeing the state lose business to Illinois. And it'll make it much more profitable and much more economic for those operators in the state of Missouri to succeed. So that's the type of lesson that may be non-intuitive to the government officials, but by lowering taxes, you're going to actually do a lot better on the revenue side yourself. But at the end of the day, whether you're lending on real estate or in cannabis, it's as much the jockey as it is the horse. You need a borrower that's committed to whatever the underlying collateral is, and it is going to take steps to want to protect it, as opposed to just throwing up their hands saying, you know what, I'm just walking away. That is really the most important aspect to getting repaid and to having a good lending experience, frankly.
As we close the conversation, no one has anything approaching a crystal ball. But as you think about the business plan and the business growth plan for AFCG and just the industry in general, what does that look like out a couple of years? What are the things that you're keeping a careful eye on, a watchful eye on in terms of, again, perhaps regulatory change or just other opportunities to build out the portfolio? What does the next couple of years look like for you and your team?
So for the last certainly 3 or 4 years, which was a surprise to us because of COVID, real estate prices have seemingly gone through the roof, certainly in things like multifamily, industrial properties, single-family homes, to the point where cap rates have compressed so much that it's very difficult for us to find something attractive to purchase. With the Fed hawkishness, interest rates rising, and a potential for a recession on the horizon, we think we're going to see better deals come our way in real estate. We have to remain patient, though. There is a tremendous amount of money on the sidelines, but at the end of the day, a real estate property has to have enough cash flow to support the price you're paying and make sense. So we think that's going to get more and more attractive. We think the lending environment is going to become increasingly difficult, both because of execution, whether it's the cost of labor, the cost of materials, the supply chain, the time it takes to get anything delivered. So we're more cautious on real estate lending than we've been. Couldn't be more positive on the long-term view on cannabis, but near-term very cautious there as well. But at the end of the day, whether it's the Fed or whether it's the state legislature, the Congress, it's really those variables that give us the most worry and concern because they're really unpredictable.
And then what, just again, with regard to, let's say, the positive outcome where the business, let's say, of lending into the cannabis space is thriving in a couple of years, what needs to happen? What are the variables that need to flip positive for that outcome to materialize?
What'll really do the trick is if the federal government says we're going to fully hand this off to the states individually, and we're going to decriminalize marijuana and allow money movements between the states such that banking can legally occur. If that were to happen, you would see new entrants into the space, but you'd also see the ability of cannabis companies to get bank leverage, to expand with lower cost of capital, and therefore grow and succeed. There's a lot of industry-specific knowledge one has to have to successfully lend. So we think we actually thrive in that type of environment, even though you have increased competition. And we think eventually it's going to have to happen, which is why we are so optimistic on the space for the long term. So again, I hate relying on non-market forces, but in this case, I do think the federal government is going to have to make some moves in order to allow this industry to properly grow, and I think they will.
And then just last question, just in terms of clearing price. I know every deal is different. Every evaluation of collateral is a unique one. But if you were to try to think about how the clearing price of lending gets impacted in terms of the federal government coming in and giving the industry in some ways a blessing and giving access to the borrowers, much broader access to the financial system, what do you think the impact is on the clearing price of the loans?
Well, right now, because capital is so difficult to access, we have a loan to a publicly listed company with a market cap of above $2.5 billion and EBITDA north of $400 million. And that loan is in the teens. That's ludicrous, even in an environment where the 10-year is up to 295. That credit should be borrowing, 800 basis points tighter. And because it's borrowing where it is, in the short term, that's great for us. But in the long term, that company can't grow as successfully as it could, and we can't make as many loans, and we can't access capital markets ourselves. So the clearing price right now is, order of magnitude 500 to 1,000 basis points north of where it should be. And that would certainly normalize as the legislative environment gets less ludicrous and more supportive of entrepreneurs trying to build these companies. In terms of real estate, you have a clearing price that's still significantly tighter for what I'll call quality properties. So occupied multifamily, industrial properties, A quality office in large cities. But some of the out of favor real estate, such as B and C class offices, have themselves a much, much higher clearing price. And if one were to want to borrow there, are they being charged too much? Probably not, given the risk the lender's wearing when it comes to some of these assets.
Well, all this stuff will be very interesting to see where it all goes, especially in light of, this newfound risk called inflation. And as you referenced, interest rates that aren't really high nominally, but are certainly much higher than they were even 6 months ago. So, Jon, I really liked catching up with you. This was great to learn more about these businesses, and appreciate you being a guest on the podcast.
Thank you very much, Dean.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.